Okay. Welcome, everyone, to this legal office hours. Today's topic, tax issues related to entity and deal structuring. My name is Will Smith. I'm the host of the podcast, Acquiring Minds, a partner in Minds Capital, a fund that invests in independent sponsors. And today's hosts are attorneys James David Williams and Bill Barlow. James David and Bill are partners in Barlow and Williams, a practice that specializes in M&A in our market. They're at the front lines. Their focus is helping searchers and independent sponsors like you all do your deals. They represent sellers as well, so they are familiar with both sides of the table. We also have with us today guest Josh Siegel, who leads the tax group at Albrecht Law. Welcome, Josh. Good to see you back. And the way we run these is that the Bill and James David and Josh will give the presentation, and then we'll do Q&A. To ask a question, use the Q&A function of Zoom. We have chat turned off. If you have a very detailed question, sometimes that can be hard to ask live, but put it in there because James David will see it after the fact and try his best to respond to you personally with an answer. We are recording, as always, and we are going to email you that recording with a link to the slides, as always, as well, in the next day or two. And then finally, here in the chat that we can use is our links to James David and Bill. Connect with them on LinkedIn. There are their email addresses, and there's Barlow and Williams, the firm, as well. And Josh, I'll also add your LinkedIn here as I stop talking. And that is my piece. Over to you guys.
All right. Thanks so much, Will. I'm Bill from Barlow and Williams. Just a little bit about us. We're an M&A law firm. As Will said, we specialize in this market. We operate on a flat fee basis. When you work with us, you work with us. It's just James David and I. And I'll just pass it over for Josh for a second to introduce himself, and then we'll jump into the presentation.
Yeah, thanks everyone for joining. I think we have an exciting presentation here on something that I find really interesting, tax structuring, and how that really can add a lot of benefit to your deal, doing it right up front. Both on the buy and the sell side can get a lot of nice benefits. So I lead the tax group at Albrecht Law, and so looking forward to it.
All right. So the first thing we're going to talk about is general deal structures. And so you might have heard the question of, am I going to do this as an asset purchase or an equity purchase? You might see that when you're drafting your LOI, right? Because usually at the very beginning, you say, I'm buying the assets or I'm going to buy the equity. We've seen LOIs that say that they're buying both, which is incorrect. And one of the questions we get frequently asked is, under what circumstances do I buy the assets? And under what circumstances do I buy the equity? The general default should be an asset purchase, especially for people that are kind of in the more ETA searcher side of the market. There's fewer legacy liabilities for the buyer. You get tax depreciation, which is really great, and it's pretty simple. Why don't you do it? Well, sometimes you have long-term licenses that more often it's usually long-term contracts that you might have that it might be difficult to assign. You might not assign it. You might not want to really let the customer know there's a change of control because they might cancel. There's also sometimes where it can be not the favorable tax treatment for the seller. And it can be a little difficult to roll equity. And if you're rolling equity, which is not as common anymore with the new rules, but if you're going to roll any equity, you can never do it in an asset purchase using the SBA. You can do it if you're doing a non-SBA deal.
Yeah, so Bill, I agree with what you said, and I think one important thing, especially for a buyer, is to pay attention early. And one of the earliest data points you should try to find out from a structuring perspective is what legal entity type is the selling entity. Is it a C corp? Is it an S corp? Is it an LLC? And sometimes you see LLC and you're like, oh, it's an LLC, it's a partnership, but it can be a bit misleading because an LLC, can file a form in the IRS to be treated as an S corp or a C corp. So just confirming those details, pre-LOI will really allow a smooth LOI process in terms of, knowing what constraints may be there from a seller's perspective and what to consider, as you, draft the LOI and, state your intention as to what what you want to buy.
Yeah, and pro tip there, if you ever ask, how do I know? Well, it might be in the sim, but in the tax return, there'll be a little form in the upper left corner, and it'll say what form they're filing, and that will tell you what type of tax structure the entity is. So,
Or, reach out pre-LOI. That's always really the best answer. And
yeah,
then,
sure, of course.
we'll be there to help you draft that and make sure everything is, on point from day one.
So now I'll talk about stock purchase. A stock purchase, equity purchase. If you're buying an LLC, it can be a membership interest purchase. All those are practically the same thing. The benefits of the stock purchase are it's smoother from an operational standpoint. Like you don't have to go to the DMV to retitle a bunch of vehicles, and you don't have to rehire the employees. You don't have to. You don't have to change the bank accounts. There's just certain things you don't have to do. Uh, it's easier to roll equity than a stock purchase. If you're using SBA, again, as Bill said, this is the only way to do it. And it can be more favorable tax-wise for the seller, depending on the seller's entity structure a little bit. The downsides of the stock purchase are that you, as the buyer, are taking on basically all of the legacy liabilities. In an asset purchase, you can shed some of them, but in a stock purchase, you're taking on all of them, and that includes tax liabilities. So it's one of those things. Tax diligence becomes more important in a stock purchase, which is often separate from quality of earnings diligence. Not everyone is familiar with that, but those are often separate things.
Yeah. Thanks, James David, for
Um,
pitching tax diligence. It's something that I've done tax diligence now, probably over a couple hundred deals. The biggest was 39 billion, and then do a lot in, the searcher and independent sponsor space. But yeah, regarding successor liabilities from a tax standpoint, in an asset purchase, you there's still inheriting some tax liability, but it's with regard to the non-income taxes. And in a stock purchase, so buying C Corp stock, S Corp stock, you're really the successor liability spans income and non-income taxes. So even in an asset purchase, I still would always recommend, look at employment taxes. Are the employee classifications correct? W-2, 1099, are they filing sales and use tax correctly? It always makes sense to kick the tires, and that's generally not something that a QOB provider has, would focus on, right? They're focused on the financial side, and then, have to make sure you're covered on the tax side as well.
and there can be some differences regarding tax treatment if you're purchasing the stock of an LLC as a partnership versus a corporation. There can be real differences there in terms of the ability to depreciate or not. So now we'll talk a little bit about reorganizations and tax elections. So this is sort of a kind of subset of these acquisitions. So we're going to talk about three things, all of which are in an equity purchase or in a stock purchase structure. So the first, sort of the F-reorganization, where seller is generally an S corp, which for those who don't know, right, S corps have a number of restrictions to them. Perhaps the most relevant here being you can't have entities that aren't disregarded. So like an investment fund can't own an S corp, and so private equity companies we'll do something called we'll do an F-reorg in order to buy the equity of an S corp. Josh can explain the mechanics if we needed it, but basically it takes the S corp and makes it into a disregarded entity that you then you ultimately buy a disregarded entity. But Josh can provide a little more detail. I've implemented them, but sometimes these charts can get pretty complicated. So
Yeah, so an F-reorg is sort of, think of it as sort of a hybrid. It's a way to synthetically get to an asset purchase, right? So when you have an S corp and the seller generally wants to sell the stock and you as a buyer generally don't want to buy the stock because then your basis is in an S corp, it's not as trapped as it would be in C corp stock basis, where C corp stock basis is just stuck, right? You can't amortize it, depreciate it. You do get the benefit when you exit and sell because you have basis in the stock, but it's not beneficial on a current period economic basis as it is if you can step up the basis in your assets. So here, if there's an S corp, you do an F-reorg, and as James David said, it's a few step process, and this is purely a pre-transaction sell side process. So it's important to, again, in the LOI to lay this out, right? You want to key in the seller as early as possible that you're buying it, your purchase price is dependent on an F-reorg, and the seller being able to execute that. Um, from a tax perspective, it's pretty vanilla. Like, there's revenue rulings, there's regulations in the tax code. This is very supportable and done, you know, I don't know, in many, many deals every week. I do a lot of them. But yeah, so you go through this pre-sale transaction, it's all spelled out, and ultimately you are buying a disregarded LLC. The disregarded LLC retains the historical EIN. So this structure again it's very nice because you're buying assets for tax purposes, but you get the continuity of historical EIN, historical bank accounts. Most times the licensing will go, again, that's a state issue, not really a tax issue. So, we always have to double check depending on the state and the industry. But this is a really nice transaction type to benefit the buyer and as well as, there can be some inefficiencies for the seller, but they're typically, much less prohibitive to structure this than if you were to say try to do an asset purchase out of a C corp, which is very inefficient from a tax perspective.
I have one sort of question I'll interject for you, Josh, which is sometimes we get to situations where you have a searcher who is looking to buy a company. They come across a company that they're interested in, and it's an S corporation, right? And a lot of times a seller, they're not very sophisticated about deal stuff, and they're like, I don't necessarily want to do an F reorg, or I don't know what that is.
Mhm.
We often get the question, which is a buyer then says, hey, what would happen if instead, because I'm just an individual buyer, what would happen if instead I just bought the shares of the S corporation instead of doing an F reorg? Could you just speak a little bit as to kind of that sort of question?
Sure. So, it's really an economic, calculation to the buyer. So if you buy the stock, whatever, just call it $1 million purchase price, right? Your $1 million purchase price will be in the basis of your S Corp stock. So, right, like as you earn money, an S Corp's a flow through, you're getting a K1. So, regardless if you take the cash or not, right, as you have taxable income, your basis goes up. And then as you take the cash, your basis comes back down. And so you have this $1 million of basis. So in the event that, there's some non-taxable income, or you say, hey, this is growing and we can take out a loan and distribute cash, right? There is the ability to use that basis and take cash that ultimately, it can save you some money on taxes. But that's, kind of a question mark, right? It's not a given. Now, if you do the F reorg and you buy the assets, you're treated as buying the assets. That $1 million is allocated among all of the assets on the balance sheet. and generally it's based on a fair market value that the buyer and seller agree on, and this is all laid out in the purchase agreement. And oftentimes we'll put a schedule, in the back to kind of lay it out so there's no disagreement. And then anytime there's no hard assets or, it's beyond the fair market value of the assets, it all goes to generally to goodwill. And so now with the latest tax cuts, anything allocated to an asset with a tax life of 10 years or shorter, can generally be written off in year one. So time value of money, I mean, that's huge. If you can allocate, say, 300,000 or 400,000 to short life assets on $1 million purchase, you're getting, and it's a flow through, you're getting 37 cents on the dollar in year one economic benefit, structuring it as an F-reorg and buying the assets versus just having that basis stuck in the stock. And, you're not really getting any benefit until you can, use the basis. And then also, just to go back to the goodwill, so I mentioned the shorter life assets, goodwill is amortized over 15 years on a straight line basis. So again, it's not the huge benefit of taking it all in year one, but you're still getting a nice benefit on a straight line basis over 15 years that ends up being a tax shield for the company as well.
Go ahead, Bill. You can do the 338.
Okay. It's always who gets the joy of it. So 338H10, I want to advise you guys to be a little bit careful about this because all the time searchers come to us and they hear, hey, the seller is looking to sell their company. It's a C corporation, but don't worry, you can just make a 338H10 election and, you're fine. Often brokers who don't really understand the process will kind of sell you on this to get you to agree to do a stock sale, even though you often shouldn't agree to do that. One of the reasons why is because the buyer has to be a corporation, and a lot of times searchers don't actually acquire as a corporation. Oftentimes they're an LLC when they acquire. So if you aren't a corporation, you're not structured that way, you can't make a 338H10 election. And the seller also has to be an S corporation or a corporate subsidiary in a consolidated group. So in the scenario I just mentioned, where the seller is a C corporation, not an S corporation, uh, assuming they're not a corporate subsidiary, which they almost always are not, I'm sorry, but 338H10 just doesn't apply, right? And if they were an S corporation, you probably are going to do an F-reorg anyway. So these are 338H10 is something that does happen. We've done deals like this, but I would say if you hear that somebody wants you to do 338H10, you have to be really careful about what structure the seller actually is and whether or not the seller actually applies, and also what structure you are. If the seller is an S corp and you are a C corp, you could do this. But then again, why wouldn't you just do an F-reorg? That's in many ways even more beneficial to you. We see this happening, by the way, all the time when we're like, we just did a deal where we, an S corporation, the seller was selling to some big corporate conglomerate, right? That's very common. But for searchers and independent sponsors, this is less often a tool in the toolkit.
And the counterpart to the 338H10 is something called the 336E. The deadlines around when you have to file some of these things are tighter in this. This one is not as limited. It can be individuals, it can be an LLC, a partnership, the buyer entity. The seller has to be the same sort of entity, either S Corp or C Corp in special circumstances. And usually it's just better to do the F-reorg if if you have the choice between the two.
Yeah, and in the searcher and independent sponsor space, like it's generally only going to work if the seller is an S corp, because for the seller to be a C corp, it has to be a C corp in a consolidated group. So if you don't see if you look at the org chart and there isn't like at least two C corps that file a consolidated return, or you look at it and it's a pretty complex org chart and you're just doing a carve out of one entity and they're all C corps, these elections generally are not going to work for a C corp. They won't work for a standalone C corp. They can work for an S corp, but again, for a lot of reasons, I think an F reorg is just much cleaner if an S corp is involved. From a buyer perspective, again, going back to the successor liability, right? You're not buying the historical S corp. You're getting the EIN, you're getting the continuity, but you're not buying what the IRS deems to be the historical S corp. That stays behind with the seller. So you're leaving behind the historical income tax risks. Now, if you make a 336E election or a 338H10 election, you are buying the historical legal entity. So again, similar to a stock purchase, you're taking on, kind of the maximum level of historical tax liability. In these scenarios, along with, buying the stock of an entity, would heavily recommend, full tax diligence. Yeah. But again, in or like if a broker's throwing these out there and he doesn't have and you can't quickly consult your CPA to know that it for sure applies or your attorney, then I would be resistant to agree to buy equity and just say, oh, this will work.
Yeah, because it usually doesn't.
Yeah.
So we'll move on. So now we'll talk about holding company structures. And holding company here is meaning, the vehicle, the company that you're going to use in order to make your acquisition. It doesn't have to be we're not talking about just a holdco with subsidiaries, but here we're talking about the company you'll use to make your acquisition.
All right. So the first thing that is probably the most common is a LLC. These are generally taxed like a partnership. And if you are if you just have one owner, it's just called a disregarded entity. The IRS practically treats it like it doesn't exist. Um, this is often the standard for a lot of searcher deals. And, if you're looking to buy a business and it's generating a lot of cash flow and you're going to be holding it for a long time and just having it generate cash flow onto your balance sheet, then the LLC is a really great option. There's a reason why, for instance, real estate companies are almost always, or real estate in general is almost always held in an LLC, is because it's exactly that type of asset. Now, there are some cons with this. The con is that it's not eligible for QSBS. So that's qualified small business stock. And we're going to talk about that in a moment when we talk about corporations. But just know that even if you're an LLC and you elect to be taxed as a corporation or whatever, like LLCs, LLCs in general, those are just not the sort of vehicles you would generally use if you're going to go for QSBS.
Yeah, and then the kind of main alternative is the corporation. And then there's this is talking about C corporations. There's also S corporations, which is on the next slide. But this is C corporations. So these are going to be preferred by certain investors if that's relevant. Anybody who's doing, if you have investors who are used to, venture capital style startup investing, they're going to expect a C corp. That's probably not that common in, searcher deals or sponsor deals. Those are different asset classes, but that gives you a sense. Potentially eligible for QSBS, which we'll talk about in just a second. The cons of the corporation is, you have, it's more restrictive in terms of the governance. A lot of states have different sections of their law for corporations and limited liability companies, and corporations are just more rigid, more formal. And there's also, during the time you own the business, right, there's the LLC will be a disregarded entity. or tax to the partnership, but the corporation will pay income taxes inside the corporation. I think the current federal rate is 21%. And then if the corporation um, distributes money out, or then that's a dividend, and that's subject to an additional tax. So you probably heard of double taxation. That's what that means, which results in a slightly higher tax rate along the way if you're distributing out money. But the corporation does give you the ability, if it qualifies, for qualified small business stock. You might have heard this as 1202 is the section in the Internal Revenue Code. So 1202 stock, that's the same thing. And what that allows is for the gains to be partially or fully tax-free from a federal perspective. There are certain limits to that. I think it was 10 million or 10 times your basis. Now I think it's 15 million or 15 times the basis. And some of this changed in July. And now also, right, it used to be the case that it had to be a 5-year hold period in order to qualify. Now you can get half the benefit at 3 years, 3/4 of the benefit at 4 years, the full benefit at 5. But there are certain restrictions. Like there are certain businesses that aren't eligible for QSBS. It's like I have a law firm. You couldn't do QSBS for that. For example, there's also some kind of tricky nuances about original issuance stock that maybe I'll let Josh come in and talk about that because that can trip people up sometimes too.
And I'd also like to say, just high level, like let's say you bought a company or not really say you can issue yourself shares and then you then exited the company in a couple years for, $15 million. Then when you sell the company and you get your $15 million, that's entirely tax-free or can be entirely tax-free if you're doing QSBS. If you didn't have QSBS, you'd have to pay long-term capital gains on that. So that's what we're really talking about. It's a really significant difference for you in terms of whether you pay long-term capital gains or whether you pay nothing. And no tax is obviously better. But just so that you're thinking about why it is that this matters, that's the main difference. You're either paying long-term capital gains or you're just basically not paying anything when you go to sell the company.
Yeah, I think, one of the really most important questions to have up front with a buyer is like, what is your goal for the business, right? Because, I can tell you like, oh, this is the best tax strategy, this is the best. Well, it really depends on what are your goals as a business owner. What are you going to do with the business? How is the business going to perform? Some businesses are real cash cows, right? It doesn't build a lot of enterprise value, but it can throw off a lot of cash. And in that scenario, going after QSBS might not make a lot of sense because as James David said, you can incur 2 layers of tax and tax inefficiencies on a go-forward basis. And if you're not building up a big enterprise value to sell and take full advantage of the QSBS, being a partnership and being in flow through and having, this kind of the streamlined taxes of 1 layer can make a lot of sense. On the flip side, if you can say, hey, my business can pay me X salary, I'm good with that, and I'm going to build up the money inside the business to make additional acquisitions, to grow the business, add machinery, add locations, add headcount, and it's really the goal is to grow enterprise value. That's where a C Corp can make a lot of sense because then on a current period basis, you're going to pay tax at 21% as opposed to 37% at the highest individual rate. And if you're not paying out a significant portion of the available cash and dividends, you're really going to escape the second layer of tax. Any salaries paid out is deductible at the corporate level. So, your W-2 wages are going to be deductible and you won't, pay double tax on that. And another point to make on partnerships, if you're a partner in a partnership, you can't pay yourself a W-2 wage. So you're really kind of stuck with both sides of the employment tax, paying full self-employment tax. And, on a partnership, it would be treated as a guaranteed payment. So again, I don't want to get too complex into all of the differences here, but the point is, I guess, call me to discuss, and happy to go through all the legal entity structuring and kind of the thought process that goes through. But then specifically on QSBS, as Bill and James David said, there's a huge benefit here. It's a greater of 15 million or 10 times your investment. And that's on a shareholder by shareholder basis. So it's not like 15 million for everybody or 10 times for everybody. That's per shareholder. So 1202 is one of the interesting code sections that there is a portion that you have to look at the underlying corporation, and then there's a portion that applies to each shareholder. And so, it is a complex analysis, and it's important to kind of, have a clear view going in, and not just like, oh yeah, I'll get QSBS. Like, as Bill and James David said, are you an eligible corporation? There's requirements along the way that 80% of your assets have to be used in the active trade or business that you're running. There's after the first 2 years, there's a limitation to how much of your working capital can count towards that 80%. You can't have more than 10% of your assets be real estate unless obviously like it's your headquarters or something really tied to the business. You can't have investments in other corporations, sort of like, think Berkshire Hathaway, that wouldn't work. So there's, a lot of nuance here. As you can imagine, to get this huge tax benefit of paying 0% tax on up to $15 million or 10 times your basis federally, the government's going to make you jump through a few hoops. And this is one of the few code sections. It's not a deferral. It's like a pure exclusion. So it's very powerful. And most states do conform. I'm in California, and unfortunately, it is not. Um, but there's also tax planning. If you are in California and, you move and establish residency somewhere else in a state that does with sufficient timing, there's all sorts of planning that can be done to take full advantage. But, if it makes sense from a business standpoint and it's QSBS eligible, it can be a real grand slam, upon exit.
Josh, the state conforming bit, that means that the state taxes in conforming states would also be exempted. There would be the same exempt, so there'd be no state tax either in the states that conform. That's what that means.
That's correct. Yeah. So there's
Clarifying.
in most states, you would pay zero federal and 0% state tax in the states that conform and have 1202 in the state tax code. That's right.
I will say, right, when you get to the exit, right, a lot of times there can be a haircut, or buyers are willing or only willing to pay a lower purchase price for shares, right, to do the QSBS relative to an asset deal. So it's not completely roses and unicorns and whatever, but it just becomes a math problem.
Yeah, and the haircut's typically associated with, like we were talking about earlier, if the buyer is buying an asset or a synthetic asset deal, like an F-reorg or one of the elections we spoke about, the buyer is getting the step up in basis that they can depreciate and amortize. So they're going to take, what is the present value of the future amortization and depreciation that they're not getting? And that's sort of the calculus that they think through. Um, but there are some ways to argue back against that. And again, it's really about having, whether you're the buyer, you're the seller, having the right attorney, right deal team that can advocate for you, that has experience, with all of this stuff.
Yeah. And I will say, in the wake of these kind of changes, there have been people who have reached out to us. We just have wrapped up a project this week where we've taken an entity from one structure and converted it into a C Corp to try to take advantage of QSBS. That can be done. It can be simple. It can be complicated. Depends on what you are currently. But if you do that route, the clock starts at the point of the conversion, right? And at the point that you get your shares, it wouldn't, like you can't be an LLC for 4 years, convert to a C corp, and then 1 year later, voila. So
That's a really good point. And one of the, the timing is sort of a detriment to converting later, but there is a benefit to converting later too. Just say if you do it on day one, the value is $1 million, right? Well, you're going to be capped at the $15 million because 15 is going to be greater than 10 times the million. But just say you convert after 3 years and all of a sudden your business is worth $30 million. Okay. Well, then you could potentially, you'd have to pay tax on that first 30 million, but the next 270 on a $300 million exit would be tax free. So there is some strategy on timing. But again, not to get too much into the weeds here, just want to put some food out for thought.
we'll need to pick up speed a little bit here to get
Yeah,
to the
we need to get to
questions.
questions.
So S corps, S corp is often it's an LLC that elects to be an S corp. There's certain benefits relative to self-employment taxes that kick in. There are also restrictions to an S corp that may make it not work. Only one class of shares. You can only have individual owners. And if you blow the S election, or so you file the S election, this is something you file with the IRS, and then you don't meet the requirements of what it means to be an S corp, it automatically converts to a C corp, and that is probably not something you intended, and that can have really bad consequences. So, if you do elect to be an S corp, make sure that you stay one. It also means if you're buying an S corp, and buying the shares of an S corp, you need to make sure that the seller didn't blow the S election and convert it into a C corp. Another reason why F-reorgs can be a good idea. I don't know that we're even going to deal with imputed interest, to be honest.
Yeah, just
Let's
so you
talk
know,
about
if you
earnouts.
ever, yeah, if you ever do, sometimes people will say I'm going to do a seller note with 0% interest. That doesn't always work. There's something called imputed interest. So, from the IRS tax perspective, they're going to assume that like you should have been paying them interest. So if you're doing a 0% promissory note, just know that's, doesn't necessarily work. Or at least not as easily as you might think. That's basically what I have to talk about.
Then I'll talk briefly about seller notes, because forgivable seller notes can play such a big role in searcher transactions. And those, if done properly, are purchase price adjustments for purposes of the tax code, and are not income to you as the buyer if it ends up being forgiven. Right? Normally, forgiveness of debt is income to the borrower, but if structured properly, these notes are not. They're adjustments to the purchase price. And then earnouts. Okay, we're good here. So earnouts. So this is more kind of outside of SBA deals where we can't have earnouts, but if we do have an earnout, it can be either part of the purchase price in the sale, or kind of after closing compensation. Depends on how it's structured. There's pluses and minuses to doing that. You can have complexity around whether it's an installment sale, which can have benefits for the seller or not. But one of the big differences is, if the money is compensation as an employee or contractor after, then that's immediately expensable for you as the business owner and is ordinary income for the seller. And that dynamic exists even in searcher deals also, right? The money that a searcher pays in a consulting agreement to the seller is immediately expensable as an immediate expense for you as the buyer, and is ordinary income for the seller. So sometimes it can make sense for you, if you're using SBA, to shift money to that consulting agreement if you can, because it can generate better tax treatment for you. Sometimes not. It depends on whether some of the bank underwriting and valuation too, which is actually what I just talked about. So
Yeah. And also like the seller notes would cause it to be an installment sale as well. And when you have a seller note or any deferral of purchase price beyond the first year, if it's greater than $5 million, and that's generally going to be in the larger, size deals. But when you defer $5 million, there can be some interest to the seller who's deferring that as well. So just something if you're looking to sell, to be aware of.
Well, I'm sure there's lots of questions, and we tried to leave at least a little sometimes. So,
They are, and they're long. I'm looking at these blocks of text here.
just like the tax code.
Yes, Kathy, recording will be available. Great job, guys. This is there's a lot here. I've seen you guys present on it in various ways a few times now, and I still feel like every time I come, it's an important refresher because unless you live in this stuff, it's easy to forget all the nuances and rules and so on. So let's try to knock out some questions and then leave the rest for James David's weekend afternoon. So Wheeling says, my CPA told me that I could create a C Corp and set it aside, let the clock start ticking. And years later, if I move my LLC into the C Corp and then sell as a C Corp, I could still get the tax benefit. Is that technique of setting up a shell to start the clock accurate?
Uh, I mean, it's just, so I'll just say this, like when you look at and you go and you're about to sell, right? And you do the look back analysis, right, of the past 5 years or 3 years, wherever you're at in the life cycle and whatever benefit you're trying to get, right? There's code sections that say, for substantially the entire ownership period, you have to meet these metrics. So if you have a shell that has nothing for 4 years and then you put something in it, I don't know how you look at it and say like 80, 90% of the time I could meet these metrics because like the business wasn't, you'd look at 5 years and there'd only be 1 year of data inside the C Corp. So again, I don't know. I wouldn't say I'd be open to like hearing more maybe, but yeah, it seems to me that I'd want to have the operations in the C Corp for as much of the holding period as I could, not because of the holding period, but because of other metrics you have to meet for substantially the entire holding period of the stock.
Mm-hmm. Well, it sounds like those metrics are in place precisely to prevent against a loophole like this. So the metrics would be some sort of real business activity, I assume.
Exactly. So it's like 80% of the assets have to be used in your active trader
Oh yeah,
business.
yeah.
Yeah, that. And then again, looking at working capital, and there's restrictions on how much working capital can count towards that 80% after the first 2 years. So even in a startup, you can imagine the first, balance sheet is just all cash, and they just get funding and they don't really have a business or an asset yet. And, under 1202, you got to turn that pretty quickly. 2 years is a relatively short period of time to go from nothing to like a real functioning business, especially if you're, creating like a Facebook, something that's never existed before in the tech world.
Yeah. Great. What's beneficial for a seller? The forgivable seller note structure or the earnout structure?
I think both ways they'll get the same tax treatment.
Yeah, what's more important for the seller is what the terms are, what the conditions are to get the money.
Yeah, I don't know I mean, maybe there's a little difference about the interest of the seller note. I don't know, Josh, on that, but I mean, the principle should be, yeah, I think the tax treatment is not too different.
And the
Forgivable seller
yeah,
note versus earnout.
um,
I mean, in general, interest on
Well,
seller notes, right?
yeah, I think, if you like, under the installment sale, right? So the installment sale is a default. That's where anytime you receive payments for a deal, an asset you're selling, anything you're selling beyond the current tax year, the default treatment is installment sale. And it's not like it's not a dollar for dollar, like whatever I get now is tax and whatever I get in year 2 and year 3 is tax. There's like a formula, tax has to make it more complicated. But you basically calculate something called a gross profit percentage, and then you apply that to each payment. And that tells you how much basis I can recover and how much gain I have to report in each year. So in doing that, and if as long as you're not deferring more than the 5 million that you're going to have to actually pay interest to the IRS on the deferral of taxes, I would think they would be the same. And in the event that it's forgiven and you don't get the funds or you don't get the earnout, you're not going to pay tax. And then, you again, you might have only been able to use a portion of your basis in year 1, and then you're not going to get any future payments, and then you can use the rest of your basis, and it potentially creates a loss like in year 2. So I would think they'd be similar.
And to James David's point, right? I think he hit the nail on the head. This really isn't the economic point here when it comes to seller notes versus earnouts, right? It's the terms of the earnouts, all that other stuff. Like the financial difference, whatever it is not important compared to the fundamentals.
And the fundamentals are earnouts you got to earn.
Yeah,
Forgivable seller note you get as long as you don't screw something up, as long as it does you don't screw it up. So
whatever the metrics are, yeah.
Mhm. I'm under LOI and in diligence to acquire the assets of an LLC where the seller currently files as an S corp. It's an SBA deal. Any advice on how I should structure my side of the transaction? I feel like this is cut and dry with an operating LLC buying the assets, but wanted to ask.
That would be the normal thing. From your perspective as a buyer, likely unless you find a reason to change it, whether that be government contracts or something like that. My assumption would be that you would structure it exactly the way you are.
Yeah, it's really a
Right.
matter is, do you need the historical EIN? Do you want the bank accounts? All of those sort of things that wouldn't necessarily transfer in an asset deal. But yeah, from a deal standpoint, step up in basis, all of that, buying assets is a good structure.
I'm looking at acquiring a family business since it's a pass down to me. So I guess their family business. My acquisition cost is essentially paying the seller 40% of their salary for the next 15 years, which will effectively be the seller's retirement. How do I best structure this purchase for both me and seller? Interesting one. Two in the weeds. We can put a pin in it.
Yeah, it's good. I mean, I'll let James David and that seems like a very specific detail.
Yeah.
Like
I was gonna do that one over the weekend.
Okay, that's fine.
Yeah.
Let's move on. Sorry. Great. Sorry, Dakota.
But if you have submitted a question, do make sure that you're registered and that it's not showing up as anonymous, because if it shows up as anonymous, then I won't get your email and I won't be able to answer your question.
Great. Thank you for that reminder, James David. Yeah, that looks like there's at least 4 or 6. Yeah, there's a handful of anonymous questions in here, so can't answer you if you don't know who you are later. Okay. Okay, sorry. A bunch of these are, so this one I think was covered, but when I buy an S Corp, can I change it to a C Corp or LLC? What will be the impact?
So if you chose to purchase the assets of the S Corp, then you can certainly do that. By just setting up your entity as either an LLC or a C Corp. If you were to purchase the shares of the S Corp, then it gets a little more complicated in terms of conversion because it can trigger some taxes. I don't really want to deal with built-in gains taxes if we don't have to, but But anytime you convert an entity, there's the potential for tax ramifications as a result of that conversion. But again, if you're just buying assets, then you can set up your entity however you want.
Any SBA specific constraints that affect deal structure or equity requirements that you routinely see in transactions like this?
So there can be limitations, right? As we mentioned early, like on the first slide, right? You can't do an equity roll combined with an asset purchase in an SBA transaction anymore. You could, and then they took it away. It was called the multi-step partial buyout, and they took that away with the most recent rule changes. I will say there have been a couple times in the last few months where an F-reorg is contemplated, and if that is the case in an SBA deal, it's better to go ahead and try to analyze the tax consequences sooner, because if there needs to be any sort of gross up or an increase in purchase price to account for extra tax that the seller has to pay, you want to know that early, because if you find that out later, then it might force you back to an earlier step in the underwriting process, because SBA loans are going to be underwritten at a particular price. So if an F-reorg is in play, it's probably best to like try to sort through as much of that as you can, and so the seller doesn't, push for an increase in purchase price, because that could add to your deal timeline. And that's sort of unique to the SBA situation.
Can you speak to acquiring with ROBS and how to then convert that to a QSBS strategy? Like many in middle age, most of my capital is tied up in my 401k. Okay.
So the nice thing is with ROBS is you're essentially required to buy it as a C corporation anyway. And so, you're going to fund into a C corporation, use that to make the acquisition. And then, the real question is what does your exit look like? The difficulty, of course, is that you're going to be taxed along the way. And a lot of the times, these smaller transactions, when you sell, the buyer is going to want to depreciate the assets. So it's if you do the QSBS play, the buyer won't be able to do that. And so I'm not saying that you can't do that. That's probably what you're going to end up having to do, because you're not going to want to sell assets in a C corporation anyway. So I guess you might as well go for it. I don't know. I don't think there's anything specific, Josh, beyond just the fact that you're going to be a C corporation.
Yeah, you're
So,
going to be a C corp, and then I just had a transaction like this that had ROBS, and they wanted QSBS, and there was other outside funding too. And yeah, if there's issuing C corp shares, right? You just have to have initially issued shares. It has to be a C corp. And then as long as you meet the other requirements, it should be okay from a QSBS standpoint. And, if there's other investors, right, that like just say there's another partnership where people are coming into and they want to get shares in the C Corp, then you just need to you can hold QSBS through a flow through entity. So if you and investors come in through an LLC tax as a partnership and want to ultimately own 100% of a C Corp, you can do that. You just have to be a partner in the partnership at the time the partnership receives the initially issued shares of the QSBS eligible C Corp. So yeah, like I know, ROBS is specifically set up to fund with retirement plans, but as long as it's a C Corp and you have initially issued shares and the business otherwise qualifies, and we're kind of simplifying everything, meets all the other requirements we've kind of gone through, then I think it should be fine.
We'll do two more here. I've heard that for independent sponsor deals, that it's something of a gray area as to whether the sponsor's carry is eligible for QSBS. Assuming the deal is otherwise structured such that shareholders are eligible for QSBS, do you know of any ways to ensure that sponsor carry also gets the benefit of the QSBS?
I mean,
It is.
this. No,
Oh, go ahead.
no, go, Josh. Go for it.
I was going to say, I'm a part of a national panel with people from the national office of some of the big four accounting firms, Goldman Sachs, big law firms. We meet once a month to talk about QSBS. It's something I've done a lot of work in, and it is a gray area. Some of these things, like for a long time, while corporate tax rates were at 35%, it was very rare that someone would structure even with the benefit, structure into using a C Corp, even with the benefit of QSBS, because that 35% corporate tax rate was really prohibitive, especially with the two layers of tax if you distribute out dividends. Then in 2017, with the first tax cuts, by Trump, lowering it to 21% corporate tax rate, all of a sudden you see a lot of private letter rulings start to come out of the IRS on QSBS for some of the gray areas. And they've been helpful. The more private letter rulings, the more insight you can see into how the IRS thinks. I haven't seen one specifically on, carry interests, but it is a gray area. There's some articles I've read and people argue for it and against it. And I guess beyond that, we'd have to get into some, really the weeds and, maybe we can do that offline.
Great. Going back to earlier in the presentation, so regarding the section 33X, so what is it, 330H10?
It was 338H10 and a 336E.
Is the takeaway basically don't do it? If you hear about a broker or seller saying that that's what they want, slow down and talk to your advisors, treat it as a bit of a flag?
Well, I don't know about a flag, but a lot of people throw it out in a pretty blasé manner when it's not possible. And so just especially the 338H10, right? It's really, unless you're doing a corporate carve out, right?
Yeah, where we see it often is when the seller is a C corporation and they, they want you to think that you can still depreciate the assets, even though it's like, sorry, seller, you made your decision to be a C corporation, and one of the consequences of that is that your ultimate buyer is not going to be able to depreciate the assets. And so, I like that's where brokers can be either intentionally or unintentionally kind of dishonest about whether or not you can actually use this. And you just have to be careful if they say this, be careful.
Yeah, I think it's what you said at the end, check with your advisor. And then also for these elections, there's post-closing requirements that have a very strict timing component. And even post-closing, if you don't meet your requirements in the required timing, it can blow the election, right? Something like even post-closing. So, if you are doing these elections, it's important to have like reps and warranties of who's doing what, and if it does get blown, that you're, protected for that. But yeah, talk to your advisor, see if it's possible, and what they may recommend. And again, the F-reorg is certainly an option to replace both of these, and usually like the recommended course.
Great. Okay, everyone. We're going to wrap here. We're right at the hour. Great knowledge that you brought, gentlemen, and explaining of these dense topics. So thank you very much, as always, for a really strong webinar. Josh, thanks for joining us. Good to see you again.
Thanks for
everyone,
having
we were recording, so you'll get a link to the recording and the slides in your inbox here in the next day or two. Connect with James, David, Bill, and Josh at the LinkedIn and email addresses I just put into the chat there, and Barlow and Williams URL as well. Any final thoughts, or should we wrap up? All right. Well, thank you everyone for your attention. Guys, thank you as always for the great webinar, and this concludes it. Bye.